Well, I think it's a good morning from him, and it's a very good morning from me. I hope everybody's well. Welcome to Paul Archer's Monday morning, Monday lunchtime live stream. Hope everybody's good. I can see we've connected beautifully now. Got a couple of people coming online automatically, which is good news all around. So, we're going to give you 20 minutes of an update on mortgages. Really, I want to talk to you about a new mortgage scheme. Actually, well, actually not new, but you may not have thought about this one over the last month or so, but you will be thinking about it next year. And I want to give you a little objection handling technique called Have You Got a Cob On? So let's go online, let's go live. Hope you're well. We've had loads of snow in the UK. If you're in the UK, you probably know that because it affects everything. And today, all the schools are closed. The whole world has ground to a halt. Anyway, in this country, we've had about that amount of snow. For those of you in different countries like Canada and places like that who are used to snow, you probably laugh at that. But there we go. It's what it's like here. Actually, Scotland do better with snow, and so do Wales. They're well sorted out for snow. They know how to operate. But here in England, we don't. We just grind to a halt. But it's fine because we can talk to you via electronic means. So anyway, enough of that. It's a couple of weeks before Christmas. You're probably thinking Christmas all the time now. So let's talk about preparing yourselves for 2023, really, which is the key thing to do right now. So what I want to do now is just remind you of a mortgage product which you might not remember very much. I mean, it was in your CMAP. You probably studied it for like half a paragraph. You might have had a question in the exam, but you've probably never come across them at all since then. And I want to just remind you that in the current market, it's not a bad little deal, actually. Anyway, enough of that. Let's head over to the whiteboard, shall we? So we can describe this to you all. So let's just say hi at the whiteboard. I've already put up here the return, not of the pink pamper, of the offset mortgage. Return of the offset mortgage. Now, do you remember the offset mortgage from your studies? If not, I'm going to remind you what they're all about. Now, they're actually becoming more and more popular amongst mortgage brokers because the world has changed since like last year. The world has changed. Fixed rate mortgages are becoming a little bit of a gamble. People aren't quite sure what's happening with future interest rates. Everybody has an opinion, but nobody really knows what's going to happen. So fixing at say, 5 or 6% or whatever seems to some people to be a bit of a gamble. Tracker mortgages are great because they track the Bank of England base rate at a couple of percent more, maybe. But even though the Bank of England base rate is probably going to go up to 3.5%, might go up even more next year. We don't know, do we? So, what are the alternatives then? Well, the alternative is the offset mortgage because interest rates on mortgages are quite high, but savings account interest rates are still languishing very, very low. And that is an ideal environment for allowing an offset mortgage. So let's just remind you how they work first of all. So what I'm going to do is do your little graph because I'm a visual kind of guy and we learn by visual, don't we? So the whole point about the offset mortgage is that you have a mortgage. So let's just put our first line in there. You have a mortgage and this one represents interest rates. So that's high and low. There you go. So high rates. Now the problem at the moment is that mortgage rates are quite high. Well, they are in comparison to what they've been. So let's just put that into context. And this line down here represents the amount of money that you've borrowed. So that's the amount that you've borrowed. Here you go. So just for our purposes, and we'll do 200,000 there, shall we? Just to give ourselves a bit of a working paragraph coming on here. We'll do 200 there, and we'll do 100 here. So you can just see how things are working out, can't you? There you go. So that's your graph. So if we put a mortgage into that for you, so you can see where the mortgage comes in. So let's put a mortgage of a couple of 100,000 in there, shall we? There you go. There's my mortgage. Now I'm putting up here because interest rates are quite high at the moment. So I know I'm just throwing a few rates out. Let's just say 6%. So that's the 6% there. So we've got a mortgage here of 6% at 200,000. Now that, as you know, is going to give you mortgage interest payments. I've already worked this one out. So that's 200,000. Let's put that in there for you. 200,000 at 6%. This is interest only, just to keep it tidy, is £1,000 per month. So that's nice and easy to work out. And that's great. Fix it at 6% if you wanted to. Now, the whole point about the offset mortgage is that people have savings accounts, usually with the same provider of the mortgage, which is why these were quite popular from banks and building societies, because they encourage people to put their savings with them as well. That's fine. Now, this particular customer that we've got in mind has savings. So let's give them savings there. We'll put that there for you so you can see that. Oh, no, give them so much savings. Give them, drop that down a bit there, nice and tidy. We'll give them savings, and we'll give them £100,000 in savings, as you can see from the graph there. Now, the thing about savings is the rate is really low. Depends where you go, of course. You can get good rates and low rates, but we've got a few thousand on savings, which I'll talk about in a second. We're earning 0.10%. They haven't budged it yet because they don't need to, do they? Now I'm gonna just to say, I'm gonna give this savings account a 2% interest, which is quite generous actually. Now, here's how it works. Now, the savings account of £100,000 would normally earn you, here we go, so £100,000 at 2%, that's going to earn you per month, this is, and I've worked it out, 166 quid, £166 a month. Now, that is taxable. Now, obviously, you've got your personal savings allowance, 500 quid for high rate taxpayers, grand for standard taxpayers. You've got a savings allowance, but you still are liable to tax on that. So it might be slightly less than that. Now, the whole point behind this mortgage is that what you do when you work out your monthly payment for the mortgage, you offset your savings against it for that particular time, that day or that month or whatever it is. So what you do, let's just take a green pen here, is you effectively put this savings account, you offset it against the mortgage, which then reduces the amount of mortgage in which you're paying interest on. So for that particular month, just take it as a month, you've offset that savings of 100,000 against your mortgage, and the lender won't pay you this, obviously, because you're not getting interest on that for that month. But what they'll do is they'll reduce that. So that comes down, a different colour pen there for you. That then comes down to £100,000 because that's all the mortgage effectively you need to pay interest on. That's £100,000 at 6%. You don't need a calculator for that. That brings that down to £500. So although you're foregoing interest on your savings, your mortgage is only 500 quid a month for that month. Now that's brilliant, isn't it? You think about it. Now you've got a couple of options there. You can obviously save yourself some money that month in monthly payments, or you can actually just pay the normal grand and reduce your term if you've got a capital interest mortgage. So that's not a bad little option either, is it? But also, it means you still got £100,000 in savings. You haven't lost that money. So if the roof blew off the following month, you can still have the roof fixed because you still access your savings. It's pretty cool, isn't it? Now, the interest rates are a little bit higher than normal mortgages, but as competition comes in, it might bring it down again. But if you've got somebody who has a bit of money in savings and they don't really want a fixed rate, then this ain't a bad deal. So what kind of people are you thinking about? Well, first of all, Shelley and I are kind of in this position as well. But we've got a fixed rate mortgage, which runs out in early 2024. So we're probably thinking our mortgage rate is going to go right up. It's fair enough. It's just the way it works. Not happy with it, but it's the way it works. So when we come to refix our mortgage or remortgage our mortgage, then we'll probably go for another fixed rate at sort of 5-6%, whatever it is at the time. Now, we have the ability to pay a little bit of money off that mortgage beforehand, which would be nice to do to reduce the debt. And that's that's an option we have. Now, what we could do instead is take out a offset mortgage and use that savings that we've got to offset against the mortgage payments, which may well reduce the term quite dramatically. And we still have access then to our savings, which is quite an important thing to do, isn't it? So that's one example of a customer that might be relevant for this. You might have somebody who's self-employed, for example, or an owner-director running their own company. And she puts some money aside each month towards her corporation tax bill, her income tax bill. She may even put money aside each month for her VAT bill if she's a consultant charges VAT. And there's quite a considerable amount of money can be put aside in a deposit account, earning hardly any interest. So what she does, she puts that into the savings, VAT money, corporation tax money, which is payable once a year, income tax money twice a year, and offsets it against a mortgage. I think that's a brilliant thing to do. Makes absolute sense to do that. It could be a client of yours has got some money from the pandemic. A lot of people still got money that they didn't spend in the pandemic, and it's still in the savings account earning hardly any interest. A lot of people don't like to use that either. They want to keep that now in case the world blows up again. Again, offset mortgage, offset it against the savings. They don't lose their savings. That's the whole point. That's a good one, there. Now, here's one you'll love to bits. And this is for all those people that work out and create equity release mortgages. Now, equity release or lifetime mortgages or later life lending, there's a lot of innovation going on there. What you do is a lot of old people who retired are looking to release equity from their property to, maybe fund their children's education or something, like grandchildren's education or something like that, which is great. A lot of them still have money on savings. I'm not talking about people who are on, pensions credit or anything like that. I'm talking about people who are relatively wealthy income-wise, but they just want to use their property to pass on to their grandchildren early. They've got money on savings. They're earning a tiny interest rate, and they don't want to use that. And okay, you put across that you do, but they don't want to use it. So what you do is you create an offset retirement mortgage. For those people who create these things, you can thank me for that. It's just a basic interest-only mortgage. So it'll be a Rio of some description, but you offset it against savings. It's a brilliant idea, I think. But yeah, the later life market is certainly innovating on its products and things like that. So yeah, I'll put that on LinkedIn, see if anybody likes that idea. Now, your action plan then, your action plan as a mortgage advisor is think about your clients now. When you talk to them next year, and they've got this fixed rate coming up for renewal or whatever, because you can do a lot of that, aren't you? MOTing people's mortgages and stuff like that. People that want to be refinancing and remortgaging. I mean, let's face it, that's pretty much the only business you're going to do next year. There's not a lot of purchase going on. Have a look at the offset. Get yourself up to speed with various offset mortgages available, and then find out what's going on. You need to do a long-term fact find with people. You can't just do, a fact find. You've got to ask them where they're going to be in 5 years' time, 10 years' time, 15 years' time, maybe. Do a lifeline on them. Google. I've got videos on Lifeline. We talk about Lifeline a lot. A lifeline is a brilliant 10-minute thing where you just know the future of your customer, and you should do that, because that way the offset mortgage might come into its own, because they might have savings which are planned for a purpose in the future, and therefore they don't want to spend it. You could offset it in the meantime. Hey, I've given you a good example. They have a new mortgage, or an old mortgage actually, that may well become quite popular next year. I hope you found that useful. Bye. Great work, everybody. Great work. Okay, so there we have the offset mortgage for you. Okay, I hope you're all well. I hope life is treating you good. I hope you've got loads and loads of Christmas presents coming your way as well, because Christmas ain't far away. And if you want to get me a Christmas present, I'm very welcome to that one. Only joking. You don't want to do that. Okay, let's get on to our next topic. And I call this one jokingly, "You've got a cob on," or "Your customer's got a cob on." Do you like that, dear? Got a cob on. Now, cob on is a phrase we use in the English language, which means you've got a bit of a bit of a head on, bit of a face on, as the Arctic monkeys call it. It means you've got the hump about something. Actually, it's probably even more colloquial. You're in the mood. That's the point. And the whole thing about cob is that customers may give you, for whatever you're happening with them, they may give you some pushback. Maybe you're making appointments to fix up a mortgage MOT for next year, and they may well give you a bit of pushback. So you're contacting a load of people, and you've asked them for a 15-minute discovery call, and they've just said no, whatever, I'm not interested. So what they tend to do, though, is have a cob on. As I said, cob. Now, cob stands for, and what I'm going to do now is I'm going to move over to this whiteboard over here, so it saves me wiping that whiteboard out. A cob. Now, cob, if I can put it over here for you, is an acronym, because we love our acronyms, don't you? And what cob stands for are the three types of pushback you get from people. The first one is what we call the knee-jerk reaction. There you go. Knee-jerk. A knee-jerk reaction. I'll tell you about that in a second. The second one's called an objection, which is a standard thing. And the last one you may not have come across before is called a brush-off. Now, it's important to know what type of cob the customer's given you, when you're making an appointment, for example, to fix up a 10, 15-minute discovery call, so you know how to handle it. Now, first of all, an objection itself is probably not going to happen at that stage. Objections themselves are usually logically thought through problems that the customer has, and it usually comes as a result of a fact find and a presentation. Logically, they may not like what you're proposing for whatever logical reason, and then you deal with that in a more structured way. And we talk about that in other videos. But the two you may get are knee-jerk reactions and brush-offs. Now, knee-jerk reactions happen when you haven't thought about it, but you just kind of say, "No, thank you." So, for example, we went into some shops over the weekend, Shelley. I went shopping, and we went into this shop on Sunday called Cook. You might have heard of it. They do like frozen foods and stuff. It's all very nice. So we went in there, completely draped in our coats and our winter gear. And the lady immediately came up to us as we walked in. "Hello," she said. "Can I help you with anything?" I said, "No, thank you." I hadn't even thought about it. I just said, "No, thank you," because that's what I do. It's called a knee-jerk reaction. Now, a brush off is even slightly it's similar, but it's different. This is where you do understand what it is. So, say, for example, well, we went into town. I think we had a chugger came up to us at one point. These people that try and fill in a form or do some kind of market research. So you see this person approaching you, don't you? You know what they're going to ask for. And you don't want to be rude, so you just brush. "Oh no, I haven't got time. No, I need to go and get my lunch," or something like that. It's called a brush off. Now, both of them you handle in a similar way. But what you do is you merely make your request again in a polite way. So if somebody says, "Oh, no, thanks," just say something like, "Yeah, I figured you were busy, which is why I'm only looking to fix up a 15-minute Zoom call with you right now." That's a nice way of handling it, isn't it? They might say, "Well, not today, thank you. I'm a bit busy," which I figured that, which is why I'm just asking for a 10 minutes meeting with you right now. So you just literally just re-ask, don't you, if you're making an appointment. That's the way you handle a knee-jerk reaction or a brush off. You could use the first, "I figured you were busy. That's why I'm just asking for 20 minutes. It's really worthwhile because we're only talking about 20 minutes here." So you just have to have the confidence to re-ask it again in a nice way. That's how you handle knee-jerk reactions and brush offs. So the question really is then, next time your customer says no, have they got a cob on? I like that phrase, don't you? Have they got a cob on? I think it was the Arctic Monkeys that spoke about that. I don't know if it was that. Or did they? No, 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 it was Face On. Have you got a face on? I think that's the Arctic Monkeys' famous song, wasn't it? Anyway, enough of that. Let's wrap things up. So just coming out to 20 past 12, giving you a couple of ideas today, giving you the offset mortgage, which you'll probably want to deep dive back into, find out a bit more about it, because there's a bit more about it than that. And we're giving you an objection handling technique to help you next year, because it's all about next year. Next year is about mortgage MOTs. It's about contacting people, existing customers. It's about contacting new customers, referrals, especially from friends and family. Get back into that as well. Plus referrals from your existing customers and clients from last year as well. Professional referrals from lawyers, accountants. They've got loads of small business people who are looking to refinance. From estate agents, they've got loads of people they sold houses to over the last couple of years who would appreciate a call, maybe. And you've just got to get off of your comfort blanket of incoming calls and make some calls to people, fix up these refinance meetings. So the cob on thing will certainly help you, and the offset mortgage will help you with your recommendations. There. Anyway, hope you have a great week. Hope you're looking forward to a good week. There's not too many Christmas parties or mince pies or all those things or do's that you've got coming up. I think this week's the biggest week for Christmas do's, isn't it? So enjoy yourself. Take care on that ice and snow. It's pretty vicious out there at the moment. Apparently, the temperature is not going to get above naught here until Wednesday afternoon. And then it's only creeping up to 2, I think. So I imagine a lot of the ice and snow will still be around for a while. We'll see you next week for our last live stream of the year. Next Monday, same time. I'll see you then. Have fun, everybody. Bye for now. There you go.